stocks are up less than half a percentage point today after Friday's 3% drop. So where do we go from here? For that, we turned to Chris Hyzy, who oversees about $188 billion as Chief Investment Officer for U.S. Trust. That's a unit of Bank of America. Chris, how optimistic are you that equities will divorce themselves from worries about the economy?
Well, we're very optimistic. Number one, because the divorcing factor of equities versus the economy, they're using every single data point that is investors are as to whether or not to sell or to buy the market. And every single data point in any recovery is the wrong way to look at it. The way we look at it, quite frankly, is this is an operating leverage-driven recovery based upon strong profit cycle in the United States and the emerging markets. And those two areas combined will help transform this global economy from a very surplus financing, high deficit world to a more balanced economy in the next 5 to 7 years. And unfortunately, in the early part of any recovery, you're going to get very noisy data. You'll get a moose-like market, stop, start, chop, and grind. We'll take that as an opportunity to take advantage of those declines like we saw Friday. We'll use it as an advantage and as an opportunity to reposition portfolios for this better rebalanced environment.
So even if that is quote-unquote noise around sovereign debt concerns in Hungary or continued weakness on the jobs front here, the market reaction itself speaks to the level of jitteriness out there. So tell me what you're feeling okay putting money into right now.
Yeah, what you just described there is the recollection of a precedent. The most pertinent precedent we know, or prescient one, is back in 2008, 2009. Very painful market environment. So every single data point is being extrapolated and suggesting that that's going to happen again. So when we look at these market declines, if we don't see a fundamental change in the economic momentum that we are witnessing, both in the States or overseas, we're going to constantly look at reflationary assets. Reflationary assets for us is look at what the central bank is doing. They're going to constantly try to reflate asset prices in the area of technology, industrials, materials, and energy. All of those sectors in the United States.
So you're buying into energy right now?
Absolutely. But when we say energy, we are going to pick our spots. It'll be certain sub-industries of energy. It'll be areas that have greater exposure to natural gas. Obviously, the natural gas movement is going to not just be in 2010. It'll be for the next decade. We see that as a leader in the United States as it relates to overall natural resources.
How does a relatively stronger dollar and a weak euro factor in your outlook for earnings right now?
That's a good question. We ran some quick data when the Southern European stress event started to happen last year. And as we moved into the Dubai worries, we moved into to Greece and others, and now into Hungary. If you see the euro correct down to $1.15 and stay there on an average basis for the next 6 months, that could wipe away about $2 in earnings on the S&P. So you're potentially looking at 78 to 80 instead of 80 to 82 this year. And next year, you could see $3 to $4.
Yeah, that's a pretty big move from 119.55 where we are right now, but we'll keep an eye on it. Thanks, Chris, for making time.